Let's turn our attention to expenses. Business expenses are the normal and current costs of operating a business and generating revenue. Expenses are also referred to as the cost of doing business. Tax-deductible expenses must be considered ordinary and necessary to carry on that trade or business. Let me give you an example. Cat food would not be an ordinary and necessary expense for an automobile dealer. However, that same cat food would be an ordinary and necessary expense at a pet store. Some of the most common examples of business expenses are advertising, telephones, insurance, salaries and wages, contract services, repairs, taxes, travel, and others. All contribute in some way to business operations in the current time period. Expenses that benefit future periods are not deductible as current business expenses, but rather are capitalized or expensed over several future periods. A capital expense is one that adds value or useful life to property, adapts the property to a different use, or improves the property or the business's fixed assets. Capital expenses are deducted through depreciation, amortization, or depletion. We can place these capitalized expenses into three categories. The first would be those costs incurred going into business. These are referred to as startup expenses. The second category is assets used in the business over a longer period of time, such as computer equipment and vehicles. And the third category is improvements to an asset that lengthens its useful life or adapts it to a different use, such as an engine overhaul. For a moment, let's discuss startup costs or expenses. Startup costs are those incurred for creating a new business or investigating the creation or acquisition of a business. Startup costs are those that would be deductible as ordinary and necessary as business expenses if the entity were already actively engaged in a business. Here are some examples. Your client could be investigating the creation or acquisition of a business, perhaps by doing test marketing or traveling to other similar businesses in order to observe them. They could be preparing for the opening of a new business by advertising, establishing an accounting system, training employees, and paying salaries before their doors even open for business. Startup costs are not expenses, but instead are capitalized to be amortized later. We'll discuss the amortization process in a few minutes.